Okay, let's answer some questions from Sunday's market outlook. As I'm watching the market, it faded away. The rally on Tuesday faded away. The rally this morning has now faded away. I find there are a lot of questions this week, and I think it's because the market is, so uncertain. Can you make an applied video for managing margin? I've been through all your options videos and I've been selling puts and doing some spread. Well, I have done that, right? If you're looking to manage your margin, you're managing theta. And I said, when you're just first starting out, keep your theta low, 0.1% of whatever assets you have, whatever value of assets you have. Make sure your theta per day doesn't exceed 0.1% until you're good at managing that. Then move it to 0.2%. Until you're good at managing that, then move it to 0.3. But if you sold a bunch of puts, as the stock price starts to fall, your margin on your puts will increase. That is the danger. So how do you size it? You manage theta. Theta will make sure your margin stays in line. My voice today is a little raw because I've been doing live exam sessions. So if I a couple too many times, it's because I shouldn't even be talking right now. Berkshire apparently sold 50% of their Apple position, sitting on almost 300 billion in cash. To your point, they might make a move on GM. They owned GM before, and then they sold it when it had gone up. Given its cash flow, I would seem to think it would fit in their wheelhouse, especially their low valuation. Future state of the live streams. For now, they're just going to stay on YouTube. At some point, they will move to the applied level, but I don't know what that looks like, and I don't have a time frame for that. So things will pretty much stay as they are right now. Those talking about a Fed mistake, big margin to cut. Instead of 25 basis points per meeting. Oh, I see where you're going with this. That they can do faster cuts. So they're going to hold to be safe because they can always do faster cuts. Yeah, that's one way to look at it. They retain the optionality. They can cut in bigger increments than 25 basis points. Yeah, they can. It's just it seemed to me a 25 basis point cut at this point in time would have done a lot to signal that the data is coming in line. But waiting for the data to fall apart and then cutting, it just looks like you made a mistake the first time by not cutting. Considering getting a PhD in economics, best way to improve my chance of getting the highly respected university. You have to be an appealing researcher. PhD programs don't really care if you can teach or don't even really care if you like teaching. You can actually say to them point blank, I freaking hate teaching, but God, I love researching. And you're in. Beneficial, go back to school, take some math classes, other classes might improve my prospects. Well, I don't know that would improve your prospects of getting into a program. It would lighten your load in the program if you have to play catch up after the fact. Hated doing research, yep. Felt it was a waste of time, yep. Why is that? Because you're not really doing research. You're getting published. The goal is not to find truth. The goal is to get published. Truth is something tenured professors look for if they care to. As an untenured professor, you've got to get published, which means you've got to write papers that cite important people. And when these important people peer review your paper and they see that you're citing them, oh, okay, well you agree with me, you're citing me, it's making it's improving my numbers. Okay, that's good. But if you think that a field is ridiculous and you try to publish a paper saying, look, I've got evidence that says none of this stuff works, your paper is going to be reviewed by the people who hold those theories that say it does work, and they're not going to like you, especially if you don't cite them in your paper. So you got to play the game. You got to go along to get along, or get along to go along. And then once you have tenure, then you can start thinking about what you really want to do. which you rarely ever do because now you have a reputation to protect, right? So it's a colossal waste of time if you're an authentic person. Full current watch list at the beginning of the positioning videos in the applied level. I don't think I would do that. Many of the names on that list are there just for me to watch. I don't know what I'm going to do with them. Giving that out may be misleading in the sense that you may think that I'm doing something with them, but it's yeah. I don't think I would want to do that. Case of OPEC Plus struggling to maintain oil prices at 75 amid rising non-OPEC production, potential market oversupply. Are you concerned about your bullish stance on Oxy if oil prices drop? Sip of my tea here to help my throat. Every time you take a position, you're concerned about the price dropping. You're concerned about the risks every time you take a position. But you don't take a position and then say, uh-oh, there are risks. You say, what are the risks? And am I comfortable with them? And then you take a position. I'm well aware of the risks of another, drop in oil prices like we had 2014, 2015. But, if I was always concerned with, well, what if the price drops? Well, what if the price drops? Let me buy this stock. Well, what if the price drops? Well, let me buy this stock. Well, what if the price drops? I would eventually paint myself into a corner where I owned nothing but T-bills. And then I would miss everything. No risk, no reward. Over long periods of time, a balanced and diversified portfolio will outperform cash. And that's what you have to think about. It's not a matter of avoiding risk. It's a matter of recognizing risk and managing it when it shows up. So sure I am, but I mean, everything has risk. Everything has risk. So there's no place you can go where you have no risk and you're going to get equity-like returns. Doesn't exist. Long peso, do you do directly using currency? Yeah, you have to. There is no futures contract for the peso. What do you do with your peso cash? Depends on how long I want to hold it for. If I'm holding it for a short period of time, I'm not too concerned about the differential. I'm more concerned about the gain. If I'm holding it for a long period of time, let's say I wanted to buy Mexican equities, I need pesos. So it's a great trade to enter. And then you take your pesos and you buy Mexican stock with it. Seems like the market is already recovering from the previous sell-off that brought from extremely overvalued to overvalued. You think it's a good chance we head back up there? Not right away. It's not. This is not not going to be your typical V-shaped recovery. Two rallies now have failed. That's not a good sign. I've talked to other people, and it seems like GM isn't liked as a car and a company. Well, who are these other people? And when you say I've talked to other people, the proper sentence is I've talked to other people and they don't like GM as a car and as a company. And did they give a list of why they don't like it as a company? Is it because it's far more profitable than Tesla? Is it because it's got more cash flow than Tesla and Ford? Is it because it's bigger than Tesla and Ford in terms of the number of cars? What part of all that do they not like? People would rather buy... Whoa, look at the mistake you made there. You've talked to some people, and then now you're generalizing to the population from a very small sample. I don't think that you talked to 800-900 people. I don't think your sample has validity here. But now you're going from a couple of friends sitting around on a Saturday night on a couch saying, I don't like GM, neither do I. Oh, people would rather buy Ford. Did they say they want to buy this? You're generalizing. People would rather buy Ford. That's not what the market is saying. Then GM without knowing too much about it. I wonder if this perception of GM is part of the reason why the stock isn't so high. Well, I don't think so. No, I don't think so at all. You can let's take something that I don't like. I can pick a bunch of products I don't like. let's say there's something I don't like and I look at the company and it keeps putting up numbers and it keeps beating the numbers and raising guidance. Clearly, I cannot say people don't like this product, because if people didn't like this product, it would be going down, not up, in terms of the fundamentals. There's just some difference between the fundamentals it's producing and the price. I don't think it's because people don't want GM. GM raised its market share in North America and is the most profitable car company in North America. The most profitable on aggregate and the most profitable per car. More profitable than Tesla, Tesla being more profitable than Ford. So it's not that people don't like it, it's that the people you talk to don't like it, and then you decided that everybody doesn't like it. Careful with that. Ireland, 41% capital gains tax on ETF, 33% on all other assets. Make matters worse for investing in ETFs. 8-year deemed disposal rule on ETFs, meaning you have to pay tax on gains after 8 years, even if you haven't sold the ETF. Seems rather stupid. Any reason why? That doesn't seem to match anything. That there must be some logic of why that is the case, other than just we need money. And this is the most popular thing is ETFs, so we're going to tax those because that's what everybody's doing. It is the retail investor that typically would own ETFs, not the institutional. So that seems like a stupid tax law. But not if you need money. If you need money, you tax anything and everything that doesn't move, right? And then if that doesn't work, you keep taxing more. How would this influence my investing style? I don't know that an 8% difference from 33 to 41 excuse me, would do much to change the way that I would do things. I do what strategy makes me money, and if the tax system is unfair, I would think about leaving. Making a video for your applied series to discuss the most commonly utilized economic indicators. I have, and the most commonly utilized indicators change with the changing conditions. Right now, it's inflation and jobs. It's really all that matters. Sometimes it's other indicators, but I have done that. Also, do you have a video on risk management for options? A video. Almost every video has risk management techniques in it. Yeah. Would you consider making a video that discusses the basis of risk management as how to do a risk reversal? Okay, so you don't have the applied level. That's all in the applied level. That's about all I can say on that. Concerned about the level of U.S. debt? I've said it many times. It's not so much the level of U.S. debt. It's the unwillingness of the politicians to recognize that it's a problem. Neither side really is saying much about it being a problem. Trump said it, we're going to get the debt down. But I mean, he says anything, that comes to his head that thinks, well, this will get a vote. I'll say that. But he's got no plan for that. He just says it. He's not a Bitcoin fan. He just says he is because they're giving him money. He'll tell you what you want to hear if you're going to write him a check. He's there to take the money from you, not give you anything. He's there to take from you. So, no politician, no party is talking about this being a problem. So that's the problem. Debt to GDP ratio, total amount of debt, higher than ever. The question is if the debt is being used to fund economic growth or not. From my understanding, a lot of it is just used to fund wars and entitlements. I don't know. It was used to fund wars. I mean, that was a big jump in the debt. Worried that this could cause a major correction in the U.S. stock market. It's not just the U.S. It's every developed country has debt that they have to deal with. And they're going to deal with it not by developed countries here, not by cutting spending, but by raising taxes. They will chase capital away. So we will get convergence in the world. Convergence is an economic theory that says low-income countries will converge with high-income countries. We will get convergence if you take the equator, you take the northern, there's North America, there's Europe, you take the northern countries, the northern western countries, they had incredible growth. As you get closer to the border and more southwards, economic growth tends to dwindle away. Well, what you have is you have a lot of migration upwards to the northern countries. And these are people, right? Because there's not a lot of opportunity down here. And then you have taxes going up over here, so you have capital going down here. So eventually these poor people will populate these countries and these rich people will populate these countries, and you will get convergence. It's just that it's not going to be the poor countries coming up to meet the level of the rich countries, but the rich countries dropping to meet the level of the poor countries. That is, the end game. If you continually go after successful people and say you have to keep paying more and more and more, and we need more money and we're only going to go after you, you will chase capital away. Look at what's going on in the UK. They forecast, what is it, something like 13,000 millionaires are going to be leaving the UK because of the tax laws that will be coming in. So that's, the more entitlement you have, the more it draws people in. And the more you say there's opportunity, the more it draws people in. But somebody's got to pay for all that stuff. So you keep going after capital, because what else are you going to tax but capital? And capital will flee and you will get convergence. The U.S. is going to have to start paying for some of that debt at some point. I think it would be hard to tax the bottom 50% because they don't have anything. You're going to have to go after success. You're going to have to go after capital. There is no other way around it. So if you're successful in Canada, in the US, in UK, and you've earned some money over your life, you don't get to keep that. The longer you stay in that country, the more likely it is that you don't get to keep that. That's going to be taken and given away to other people who didn't earn it. That's what you got to do to get elected in democratic countries right now. Is you got to demonize a small group of the population that appears to have all the toys, right? It's possible you create a video over understanding the market outlook. I have. It is on. It's on my YouTube channel. You just have to Google understanding the market outlook and you'll find it. I mean, not Google, but YouTube search it on my channel. Question about neoclassical growth model. What's the difference between capital accumulation, capital deepening? So capital accumulation is I have 5 trucks, I buy a 6th truck. Capital deepening is I have 5 trucks, I sell those, I buy 5 other trucks that don't need drivers, right? So I buy the 6th truck, I now have 6 trucks doing some work. I replace the 5 trucks with 5 new trucks that don't need drivers, I now need 5 people less, right? So that is, that's technological progress within the capital. Why slow growth developed countries above? Okay, that's a CFA question. I'll leave that to the CFA crew to answer. For an average retail investor that's trying to build a 60-40 portfolio, do you still consider TLT or U.S. bonds interesting? Yep. Do you think the 10-year bond is valid? Yep. In a low-rate environment, how would you recommend building the fixed income part of the 60-40 portfolio? Well, we don't have a low-rate environment. We have a high-rate environment. So I don't know how to answer that one. Do you mean that when we get to a low-rate environment? I guess the question would be, and it's a valid question, I think, what is the point of a fixed income allocation at low rates? Where do we think you're getting a low yield and the price is already high? Where can it possibly go from that point in time? There, I think you'd move from a 40, well, even within fixed income, there are places you can go, right? You can go down the credit spectrum from treasuries to investment grade to high yield. There are places you can go. What was not good on the GT earnings? I'll pass on that one. That's not a short question. Calculated return on invested capital for the strips margin, the amount of margin that you need to earn, and the premium that you earned. That's it. Then you multiply it by 365 divided by the number of days to expiration, DTE. That is all you need. Do you switch between doing strips and stacks based on conviction of the stock, or do you do it mainly because of the skew? Normally a stack will do, at a certain strike price, 50 at a strike price. But, when you have skew that then elevates like this, and here's the market price, you have an elevation of volatility, but then you have heightened skew as well. So the deeper you go out of the money, the higher the implied volatility. When the market turns around, these drop very fast, so the profit potential on those is very high. And I don't want to go, all here because the premium is too low. And I don't want to go all here because the risk is too high. So if you strip them down, if you go every strike price or every second strike price, you have a nice combination of risk and premium. I see the all-in pricing applied level bundle still available on the site. Nope. The applied level still exists on the site. It will always exist on the site. It's just not all in, but the pricing is still the same. The applied level is still the same. I'll still be adding to the applied level over time. It's just that new modules that I add won't be included in the applied level. But as far as sector studies, those will continue to expand over time. That's still a valid thing. Borg-Warner 73, 77, 84 volatility. That's the 52-week, 26-week, and 13-week implied volatility percentile. What are you looking at and how are you interpreting these? Well, when we see IV, 13-week IV, 84%, what it's saying is that in the last 13 weeks, the level of implied volatility on that company right now, 84% of all the observations have been below that. That means only 16% of the observations of implied volatility have been above the number where it is now. That's in the options chain on IB. What is your best recommendation for losing positions that I no longer have high conviction on? Get out. Get out. I have some positions that I'm down massively on around 78. Oh, should have been out a long time ago. You should have a rule. You should have a rule of when you're out. Unless you have a risk management program that you can follow, you should be out. Holding something on the way down is not a strategy. Should I start selling calls? I think it might be too late. Simply continue holding them and hoping. Well, hope is not a strategy. Hope is not a strategy. I made a mistake and lost a lot of money on. Yep, you did. And you could lose more. What you're saying in your last sentence is all you have left is hope. Yeah, I would never have if you were sitting beside me this whole time and you were down 20%, I would have been, poking you saying, well, what are you doing with that? You're down 20. What are you going to do? Now you're down 30. Right? What are you going to do now? I would have been yelling at you that you should have been getting out. I would have been yelling at you every 5 minutes that you should be getting out of this thing or doing something, not just sitting there. Hope is not a strategy. I started trimming my other losing positions, but with the above ones costing about 30% of my portfolio, current value 30K, I don't know what would be a good way to go about them. By the way, you mentioned AT&T quite often. What are your thoughts on Bell Canada and TELUS? I know nothing about the Canadian market. I know nothing about Canadian stocks. I don't even look at them. I truly know nothing about, outside of the apartment REITs. I really know very little. I know very little about the Canadian yield curve. I know very little about the Canadian economy altogether. I am 98% US in my investing. You blew up. You blew up because you made some mistakes. One mistake was that you didn't have a rule about when you were out. You have to have discipline. You have to have a rule. You can't fall in love with your money. Right? When a position is down by a certain percentage, you have to have the cold emotion of just saying, well, that's it. This is not my friend. My friend would not treat me this way, so I'll get rid of my friend. And that's a good way to, sort of think about stocks. You have a group of friends. Maybe one of your friends is just not a very good friend. Do you decide, well, look, I'm going to get rid of my good friends and double down on this bad friend in hopes that they become a better friend? Um, you're holding on to some stocks that are simply not your friend. They're just taking money from you. They're just using you at this point. Um, it hurts, but you got to move on, especially being down that much. Or you can cling to hope. But, that's not much of a strategy. Have you seen VIX near 30 last week? Okay, now 2023 4 by the end of the week. Where is VIX right now? I have the VIX chart up. It almost hit 30. We're at 28.83 right now. Fluctuate above 20 for a while. I don't know. When people ask me this, do you think the market's going to go back up? I don't know. Maybe, maybe not. I have some positions where it doesn't matter if the market goes up or down at this point in time. It really doesn't matter. I'm not looking to sell it today or tomorrow or turn it over very quickly. I'm in it for a number of years, and I know over a number of years this is what's going to happen to the position. It'll do this kind of thing, and then every now and then it'll do this. Nice buying opportunity. There we go. And down, nice buying opportunity. Great. Over the long term, I'll get this, but from week to week, I don't know. Beats me. A better question is, do you know what you'll do if the market goes up? Yeah. Do you know what you'll do if the market goes down? Yeah. There you go. That's all you can do. I don't know what's going to happen. Nobody knows what's going to happen. Trying to forecast what's going to happen is just, I think, a fool's game. The better thing to do is to say, well, what would you do if the VIX broke 30? What would you do if the VIX broke 20? And there you go. Then you just sit back and you wait. You say, okay, well, what I do next depends on what the VIX does next, as opposed to trying to forecast what that thing is going to do. We're down to under 520 on the SPY. It's 2:40 p.m. Where are we going to be at 4 o'clock? Not a clue. Where are we going to be next week? Not a clue. Do I know what I'm going to do if the market goes lower? Yep. Do I know what I'm going to do if the market goes higher? Yep. That's all I can do. That is all I can do. That's it. You can have some idea of where a stock is going to go. I think the Canadian apartment REITs do well going forward. In what time frame? I don't know. But I do know that I'll do okay with them. If the market goes down, would I buy it at a certain price? Yeah, I would. Well, then sell puts at that price. If the market goes up, would you sell it at some price? Yeah, well, then sell calls at that price. That's all I can do. That's all anybody can do. Where can I find expectations for the economic indicators? They're on almost every economic calendar. Does your website allow access to all this data as it comes out? No, this is just public data. All economic data is public data. That's available from whatever website releases it. Rotation of small cap stocks is premature. Yep. Considering Fed interest rate cut impact working on a lag 6 to 12 months, as well as markets being forward looking, is it possible to correctly or at least in time the market? Is it possible? Sure. Is it probable? Very, very low probability, but there's some probability, but it's not very probable. Anything in the world is possible. So is it probable, I think, is what you're asking. You may get lucky once, but I don't know if there's anyone that has a good track record of timing over any consistent period of time. GM puts, you mentioned selling puts 11-12 for 41 strike. No, I didn't. No, I did not. I did not say that. I sold a strip. Have you been rolling it and adding the premiums? Current December premium are like $3. What am I missing? You're missing the whole strategy that I said I did. I did not sell a 41 put. I sell a strip starting at 41. Since we have been having a bull steepener in which the longer part of the curve will remain the same and rate cuts will be in the mid and short part. No, yields dropping will be in the mid and short part. Why do you prefer TLT? TLT will come down. I mean, the long end will come down. It may not be playing along right now, but it will come down. It has no choice but to come down. If underlying price is 100, 1 year IR is 5%. The 1 year at the option price is 105, right? 105, no, well, not quite. It would be the continuously compounded version of 5% less the continuously compounded dividend yield. So currently this option is out of the money. It would be out of the money, yeah. In your logic, it would be out of the money, correct. Would you say trading on sentiment has become more profitable than trading on fundamentals? I don't know that I would say it's become more profitable. I think trading on fundamentals in the long run is always more profitable. Sentiment is fickle, right? Well, what do you look at for sentiment? Sentiment doesn't have an income statement or balance sheet. Sentiment doesn't have any fundamentals. Sentiment doesn't have an intrinsic value. Sentiment is just, the bandwagon driving by. Right now it's growth scare. Well, what if the jobs number we had was weather related and it really would have been 180? If it came out at 180, we wouldn't be here. So do we have a growth scare? I don't know. But that's where the sentiment is. So you can trade the sentiment, but are we going to have a growth scare from 3:30 to 4 o'clock today? It's 2:44. It looks like we have a growth scare. Are we going to have a growth scare in an hour? I don't know. I don't know. That's why I don't really like these things about, what the market feels or sentiment. I think you do a lot better in the long term with the fundamentals because the fundamentals always show up. They always show up. What is meant by positive and negative deal or gamma? Gamma is the rate of change of delta. Right? So if you're all options have positive gamma. So if you're long options, you have positive gamma. If you're short options, you have negative gamma. Watching Charles Schwab YouTube channel, and they were saying the 5300 level on SPX has negative gamma when talking about option flows and gamma levels. Yeah, and what did that do? What did that do for anybody? Right? I mean, I don't think, I really, I hear a lot about this and about dealer positioning and this and that. It's like I don't think that has the effect that we like to think it has. I think it's somebody that knows something about this thing and that's what they're going to talk about. But no, I never heard it. No one was talking about it. Never heard anything on Bloomberg. No one brought it up. I never considered it. It didn't seem to matter at all. So, I don't know. I think if I heard somebody talking about that, I'd think, so what? I mean, so what? They're market makers. They're not the market. They're market makers. They're dealers. They're not the market. So, what they have to do, they have to do. I don't know that I would pay much attention to that. Can you sell covered calls on synthetic longs? You can. What happens if you get a sign? Well, if you have a synthetic long, you have a call option, right? If your stock gets called away because of the short one, you exercise your call and you call the stock away from someone else. Does the synthetic close normally? Nope. IBKR is letting me sell naked calls, but only when I have a synthetic long on the underlying. Well, then it's not a naked call; it's a covered call. It's a spread, right? You don't actually have a, you think you have a covered call. You're short a put, you're long a call, you sold a call. You basically have a bull spread with a short put. So that's what it basically turns into. Any comment on Pershing Square? No comment really. Wanted to do something and the market really wasn't there. And that was about it. I mean, I think it has more to do with Bill Ackman than it has to do with the market, but showed a population growth number as part of the Sahm rule discussion. Does the population growth number only include the working population? Population growth is everybody. Population growth is everyone. The labor force only includes the working age population, but population growth is everyone. Do large equity moves up and down both add to the measure of volatility equally? Not really. At the level of the index, it's really only moves down that would increase volatility. At the level of the stock, moves up will increase volatility because you'll get call buying. Very rarely do you get call buying on the index. It's much more for insurance. You get a lot of put buying, but not a lot of call buying. So portfolio managers will hedge out their entire portfolio with puts on the index. But when they're bullish, they'll buy calls on individual stocks. You did a lot of shopping last week. I did. What percent of your portfolio do you typically have in cash? I don't really know. Honestly, I don't calculate that way. I don't look at it. If you ask me right now what percentage would be in cash, I wouldn't know. More than 50%. I think more than 60%. Less than 90%. Less than 80 maybe. I don't know. I'm not constrained. Let's just say that. For what I do and for where interest rates are, I get paid a lot to be in cash, which I'll take, thank you, because I don't know that you have 5.5% upside to this market, but I'll get that in cash. That I am not, I am nowhere near capacity constrained. So from day to day, I don't even look at the portfolio balance from day to day. It's meaningless to me. If I had a smaller account, I would probably pay attention to these things a lot more. But I'm nowhere near being fully invested. Nowhere near. So I don't really pay attention. About your outside money managers, what strategy are they implementing that you would expect them to outperform? Well, it's a more conservative portfolio. So I know I will outperform them, but I do feel that we are even underperforming the target that we had overall for what I'm paying. I'm paying two levels of fees, right? You have a sponsor, so you're paying the sponsor fee, JP Morgan Wealth Management, and then they put you in funds. You have fund managers, and then you're paying the fund manager expense. So you got two levels of fees. And then you get what's left over. So when you look at what you get, what's left over, it's like, wow, that's not too great, right? When you look at the gross amount before all the fees, it's probably pretty good, but you pay big fees. That's, as each day goes by, I'm questioning those fees, thinking I could have beat all of that in just being in cash. All of it just being in cash, I could have beat it all. So. And then I have the ability to take advantage of opportunities that I clearly see, as opposed to letting somebody else take advantage of what they perceive as opportunities. And the turnover is, I keep getting notices, your trade notifications are ready. I don't even look at them because I think it would make me sick. I think there's a lot of selling on losses, which to me, it's not what I would do. It's not how I would handle things. And I'm slowly getting to the point where I'm just going to bring everything home under my own umbrella and just do it myself. I thought, diversification as strategy would work, but in the years I've been using external managers, I've not been impressed once. It's been like, I could have done better without really trying. I could have done better. So I know I can do better. So I'll let it go to the end of the year, maybe into next year. But if things don't turn around, then at that point, it's like, look, this is not working for me. Didn't mention Intel. Well, I didn't mention a lot of things. Yeah. What are your thoughts on the company's drop and if you start following them? Not really. Not really. No, not really. It's no. No, not really. I guess that's all I can say is no. What fixed strike? Oh, I answered that on Sunday's live feed. How do you find the expected TLT price given I expect 30-year to drop 50 basis points by end of year? Do you expect the 30-year to drop 50 by the end of the year? Well, how you find it is negative modified duration. TLT is what, 16.5 times 0.0. You expect 50 basis points, 0.5, and that'll give you the percentage change in the price. Primary dealer whose main function is to participate in primary auctions of government securities. Primary dealers can access the repo and reverse repo facilities from the central bank. If those facilities were withdrawn by the central bank, there may be liquidity stress for the primary dealer. Well, that would never happen. I mean, it's for the central bank to say we're going to cancel our repos is pretty much tantamount to them saying we're no longer going to set interest rates. We're never mind the target rate. We're just not going to do it anymore. I mean, they would never do it. They would never do it. So you don't have to worry about those disappearing. They would never do that. Follow-up question of this week. Wouldn't the rule have captured changes in labor force over time as well? Well, it would have captured what was going on, and I did say that, right? Is what you have to look for is out of sample observations. So you have to go back in time every time the Sahm rule triggered something when it increased by 0.5%. How was it triggered? Right now, it's triggered by the labor force growing faster than the population. It's by the labor force growing faster than the population and by the participation rate increasing over time, so that you have a labor force that's really growing, that's increasing employment. But we've had job gains every single month. When this increased by 0.5, was it that the job gains were less than the population growth times the participation rate? So population growth is 200K per year, participation rate is 62%. You need 124,000 just to keep unemployment constant, right? So if you have jobs being created less than this number, and you have a labor force size that's growing in proportion of the population. If population is growing 200K, labor force is growing 124K, and you're producing fewer jobs, that's different than saying we are producing enough jobs, but the labor force is growing faster than the population. In the previous time series for unemployment, did you have a situation where that was the case? And if you didn't, this is an out of sample observation. So yes, it does account for it, but you must go back and say, have you, in your data, do you have this type of observation going on? If you do, okay. If you don't, then this is an out of sample observation in which the original model may not work. That if you reran the model with this new data in here, you may not have as well a fit as you did previously. So, labor force is not okay, so I answered that. Is AQR's risk priority approach where they systematically overweight underperforming assets in hope of a rebound possible for retail investors? I don't know what their approach is. I don't know the details of their approach, so I can't answer that. I can't answer that one. Your portfolio versus managed, what is the horizon to evaluate the underperformance? Well, that is the point, is that you have to look at it over a longer period of time. So would you, what would make you change the bank provider? Like I said, I'll give it to the end of the year, maybe into the first quarter of next year. But if I'm still unimpressed, then I think I'll just end it. GM 36. Why did you sell them now with a low premium instead of wait? Well, because it's a strip. That's the point, right? Is you sell a strip, And if the so you have certain strike prices, let's say 41, 40, 39, 38, 37, 36. So the stock keeps falling, you then go 39, 38, 37, 36, 35, 34. If it keeps falling, you keep layering them on top like that. I don't know where the bottom is. Do you? I don't know where it is. I mean, that could be the bottom, or it could keep falling. I have no idea where the bottom is. So you'll start layering them on that way, and if the stock rebounds, you may think, I didn't get enough. But if it keeps on falling, you think, thank God I didn't do it all. So you just have to find some middle ground where you're happy on, but you can't look at an entire portfolio and an entire strategy and pick one little thing and say, well, why'd you do that? You have to say, well, you have to look at it in context of everything else I did. It's not an isolated trade. It's wrapped up in everything else that I did. So it's not like I did that one thing and you question that one thing. So if you look at my food order when I come home and you look at garlic powder, you say, what the hell did you buy garlic powder? You can't eat garlic powder. It's like, but I didn't buy garlic powder independently. You got to look at everything else I bought, and then you would say, I see why you bought garlic powder. It goes in with the whole portfolio of food that you bought. All right, so you can't just look at one thing in a whole strategy and question the one thing. All right. XLU seems like promising sector to be invested in. If I wanted to be overweight XLU, would it make sense to simply be long SPY and sell puts on the sector ETF that I want to overweight? Yeah, you could do that. Do you have any preferred readings on learning the business cycle? Not really. No preferred readings, no. Dumb question. Could you explain cost of equity in the context of Wacc calculation in an intuitive way? Cost of debt, I understand. You borrow money, there's a cost to that. You pay interest, and you can see the financial statements. Cost of equity is not intuitive to me. Well, it's estimated, right? It's just estimated. It's going to be more than whatever your most expensive debt is, because equity is riskier than all forms of debt, because debt stands in front of equity in front of the liquidation of any company. So a place to start would be, well, what's the cost of the riskiest debt? Equity will be more expensive than that. The company raises cash by issuing shares. Investors need a hurdle rate. And you're looking at it from the investor point of view. No. Most mega cap companies do share buybacks instead. If I buy their share, I'm buying it from another investor. It doesn't impact the company's cash balance or operations. Should the weight for cost of equity be zero? No. You're sort of confusing it. You have a company that needs capital. It can use debt or it can use equity. Well, it's not free for a company to use equity, and it's not free for a company to use debt. You're an investor. You can buy debt or you can buy equity. You'll get a yield on debt, and you'll expect some kind of return on the equity. That is different than what it costs the company to do. Right? So the company, the safer the company, the cheaper the cost of equity is. But it has a cost of equity. It has to return a certain amount on its equity for it to be a viable company, or for investors to keep their money with that company. When I say keep their money with that company, company has earnings and it adds it to retained earnings, it adds to equity. Investors would say, as long as the money you're keeping can earn a good return. If it can't, give it back to me, because it is mine. They own it, right? But you're confusing your expected return on the stock with the cost of equity from a company. I'm trying to calculate the Wacc for Apple. You would look at its debt, its most expensive debt, and then you would add on some kind of premium. And when you say you're trying to calculate, the better word is you're trying to estimate. Nobody knows what it is. Even Apple probably doesn't know what it is. It has its best estimate of what it is. There are different ways to calculate the cost of equity. You can calculate it in an equilibrium framework, which means you're going to use CAPM. And CAPM says, well, your cost of equity is going to be at least the risk-free rate plus the beta of the stock times the equity risk premium for the market. So if Apple has a beta of, let's say, 1 and the equity risk premium is 4.5, the risk-free rate is 5.5%. In a CAPM framework, you're probably more likely to use the long-term bond, which is 4.2. You'd be at 8.7 on the cost of equity, right? That is an estimate. That is a best guess. There is no accuracy here. It's just a best guess. Somebody else may have come up with something different, right? Because you first have to determine what risk-free rate you're using. Then you have to say, well, for beta, how am I calculating my beta? Is it weekly for 3 years? Is it monthly for 5 years? Is it a 2-year look back, 4-year look back? ERP. Well, what ERP? Your ERP has to be consistent with your risk-free rate, that if your ERP is calculated using a long bond, you better be using a long bond over here. You better not be mixing it with a short-term risk-free rate and your equity risk premium calculated using a long bond, and on and on and on and on and on it goes. And that's just one model. It is a big guess, an informed guess, but a guess nonetheless. The best way is if a company simply tells you what it has calculated as its weighted average cost of capital, then you just accept that. But calculating it is going to be tough. You're never going to get it right. Everyone will have different numbers. And here is the thing about weighted average cost of capital. Is when you're calculating, your first 5 years are usually discounted at the weighted average cost of capital. Your 6th year usually is a terminal value, which is your free cash flow to the firm, 1 plus G over WACC minus G. This denominator is super sensitive to any difference in these two numbers. So if you say, my weighted average cost of capital is 8.7% and my growth rate is 3.4. You'll get a far different value for the present value of the future if you went 0.086 minus 0.035. Or if you went 0.088 and 0.033, you'll get really different values. That's how super sensitive these numbers are. So it is a best guess, really. It's just a guess. An informed guess, but a guess nonetheless. Let's see. How do you manage the accounting of the portfolio? IBKR does it all for me. At the end of the year, it gives me everything I need. I don't have to do anything. What was your worst year since you started? I don't know. I can't remember. I don't know. Certainly not in the last 10 or 12 years. Before that, maybe, but I mean, I don't know. Said in an interview I saw on YouTube that you have 8 degrees. No, 5. Maybe you were being sarcastic. I'm curious what they are. Only 5, not not 8. 5. 3 undergrads, 2 graduates, one MBA, 1 PhD. Bit about the yen reverse carry trade. Don't know that there's much to explain. Think about it as you borrowed money from somebody and you went ahead and invested it. And now that somebody's saying, I want my money back. Well, you got to sell the thing that you invested in to give them the money back. That's the yen carry trade. So you have yen, and let's say that you have the peso. You can borrow at a low interest rate. You can invest at a high interest rate, and you have the currency in the middle. So you sell yen, which means you'll have a negative yen balance, which you'll pay interest on. You convert that to peso, you'll have a positive peso balance, which you invest at 11%. And you hope to earn the difference on something that's very highly leveraged. All your risk is right here. That's a money market rate, that's a money market rate, the currency. What you don't want is the yen to strengthen. If the yen strengthens, you got to sell this very quickly. You got to buy the yen back to pay back the amount of yen you have, because this is fixed. When you borrowed yen, you borrowed a fixed amount. That's all it is. It's just buying, sell. You got to sell the asset you bought to buy back the currency before it gets too expensive. If it gets too expensive, you actually lose money. Labor force grew by 277 and 420. No, Population. Oh, for the last 2 years, June, July. Yes. Great, very interesting observation on the seriousness of the unemployment numbers. Well, let's see what your. I could not find what the BLS report that showed those numbers. Household survey. First line across the top, population growth. Second line across the top, labor force growth. Third line across the top is the number of people employed. So they're just right across the top. Can you point to exactly? I already did. Okay. I'd like your further thoughts on if there's a lag on the way up, there's a lag on the way down. From here, it seems like entities can hold on to lower cost debt until it comes due on the way up, but can immediately roll over debt to lower rates on the way down. Also, I made that infotainment comment a few weeks ago. I don't know what that means. I'm watching it for fun, but it's not syncing in particularly well, or at least I'm not inspired to pick up the tools myself. I don't know what that means. But I mean, you can say that on the way up as well. I mean, I'm invested in assets and yields go up. I can sell those and grab higher yields, right? So it's just a different side of the equation on the way down. What if I have interest rate swaps in place? So I issue debt at 6%, but I think that rates are going to go down. I would probably want to be in a pay floating. I'd rather have floating rate debt than fixed rate debt. So I just enter into a receive fixed pay floating swap. So under the swap, I received a fixed rate, but I pay a fixed rate, and then I just pay a floating rate. So if rates are going down, I'm already paying a floating rate. I can, and there's so many tools that I can use to immunize myself from interest rates, and that's what I said as interest rates were going up and the economy just didn't seem to be responding, is that it's possible, given the level of financial sophistication, that so much of the economy is immune from interest rates at this point. What's the point of treasury buybacks? It's to improve liquidity. They're buying back off the run bonds. It's to improve liquidity. When you create a strip selling puts, I'm assuming you place all the orders on the same day. Correct. At the same time. How dividends are priced into options. So if it's an index, it is the continuously compounded rate that is priced into options. So I can only really briefly explain it. E to the R minus QT. R is your continuously compounded interest rate. Q is your continuously compounded dividend rate. And the put is priced out, and the call is priced out with these, such that if you have let's say that you have equal implied volatility and very low interest rates, you will have a dividend, a stock that pays no dividends. The value of the put will equal the value of the call at very low interest rates if they both have the same implied volatility. Now let's do nothing more than increase dividends. What will happen is that will drive up the put price, but it will drive down the call price if nothing else changes. So it's already in the value the value of the option. For a stock, we know they pay 4 times a year. For an index, while the SPY would pay 4 times a year, it receives dividends all throughout the year. So that's why we use a continuously compounded rate on that one. We use a dividend yield as opposed to dividend. But with ABR, we know exactly when it pays a dividend. So if we sell a put here that expires here, there'll be nothing in the put because you sold it and it expires with no dividend due. It's if you sell a put here and expires here, this will be in the value of the put. The call will be lower because the stock is expected to drop by 43 cents because of the dividend, and the put will be higher. I sold a few ABR puts but did not see any dividends get paid. No, you don't get any dividends. It's in the value of the put. Is it possible for retail investors to short government bonds? You can essentially borrow at these low rates. Well, I get what you're getting at. Yeah, well, yeah, it is possible. Yeah. Wouldn't that be a simpler option rather than going to a retail bank and paying? Ah, ha, 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 ha. I see what you're saying. I see what you're saying. If you're raising money by selling bonds, that money is restricted from being withdrawn. You can't just withdraw it. Yeah, I mean, you can use it for another money market security or something that is cash-like, but you simply can't just take that money out and go your merry way. That's restricted cash. Oops, let's get that back up to size there. Why buy options on NEE instead of NEP? It's because it's what I chose to do. It's what I chose to do. Since Ivan has sold shares last week, what do you think about this action? Ivan didn't sell shares last week. ABR sold shares last week. If you call up that forum and you look at the footnote, it says that these were sold to satisfy a tax obligation, which means that was in place for months. That was in place for months, and that's all it was doing is ABR sold it. Risk of rising inventory to U.S. home builders. You made some good counterpoints. Taking your points a little further, one of the biggest tailwinds for home builders is the structural supply deficit in both countries. Correct. Despite the recent run-up in inventory, I find it very difficult to believe that builders are going to ramp up spec building enough to fill the gap. I agree. So when sales are weak, starts fall, meaning very little progress will remain in filling all the demand from suppressed households. Therefore, the supply deficit persists, putting a floor on the prices. I agree. Unlike the auto industry, which in your sector you talked about how the OEM's high fixed costs force them into a structural overcapacity. That is true. Those conditions do not exist to the same degree in home building. No, they don't. It is a high fixed cost inventory. I shouldn't say high fixed cost inventory. It's the asset they're building is a fixed asset with a high cost. Only if they build it. GM has a plant. Period. Whether it makes a car or not. If a home builder doesn't build a home, it doesn't do anything. Now, if the home builder subcontracts out all the home building to contractors, it's the contractor's equipment. So all of those fixed costs are sitting on the contractor's books, not the builder's books, which would be DHI. So you're right. DHI or Lennar. Do you think it's a valid point in favor of your longs? Yeah, I do. Insurance for your truck. Don't you have websites and can't allow you to compare the car insurance price from cost different? Yeah, you do, but they know nothing about you. They don't do any search on your driving history, and you have no other cross products that lower your insurance rates. I have my home insurance with Allstate, so I should be getting 20% less on my vehicle. So that $3,400 is less 20%. In other words, they're quoting me almost $4,100 if I didn't have a house with them. Doesn't make any sense. Doesn't make any sense. 29-year-old CFA charter holder working in institutional portfolio management. Past 3 years, I have given several guest lectures at the university from which I graduated. Surprised that so much stuff I have to show to students was completely new to them and really ignited them. Passionate about teaching university students the fundamentals of retail portfolio management. My own university experience lacked practical application of theoretical concepts learned in class. Given my interest in teaching rather than pursuing academic research, what are the probabilities and potential pathways for me to become a professor at a university? Zero. Zilch. None. Zero. You don't have a PhD. Zero. Oh, you can be an adjunct, but adjuncts don't get paid anything. They get paid very, very little, which means you're doing it for love. Full time? Not really. Not much of a chance at all. Not much of a chance at all. That's the thing with universities is they hire researchers. Accredited universities must maintain a certain proportion of PhDs in their teaching staff. No, it would be almost zero. That there'd be a teaching job for you without a PhD at a university that would pay you anything more than subsistence. Maybe you'll get 5,000 a course in the US, 4 courses a semester, 20 grand. So if you do 8 courses a year, you'll get 40,000 a year in income. If you can get 8 classes, and you'll always you'll never have job security ever. It's it's something you would do if you really liked it and you enjoyed it. You'd do 1 course and only 1 course. You wouldn't do this. You just wouldn't do it. Dear God, you wouldn't do it. There's no money in it at all. And there's no job security in it either. You get 1 semester where they only give you 2 classes and you think, but I got bills to pay. They don't care. You're not a researcher. You're nobody. No. Question on currency. I stay in US and hold assets in India, which at some point in the future would like to sell and convert balance to US. Current conversion 84, central bank rate 6.5. Indian election was done earlier. Any trade suggestions? No idea. You're asking me to forecast the pathway for that currency. Not a clue. You got to do what's right for you. If you do it over time, you convert a little bit over time, then you're doing it on a moving average, as opposed to waiting for just one time. You're never going to pick. You're never going to get just the best rate, and then and that's it. So maybe over time. But any trade suggestion, you're asking me to speculate on the direction of that pair, and I don't know. Market close Monday. Let me say something about that. You probably hear me say I don't know a lot, and that's the truth. I don't know where the price of something is going, especially currencies. Nobody knows. Nobody knows where it's going. It's the future. Nobody knows. All you can do is say, if it goes this way, what would I do? If it goes that way, what would I do? That's all you can do. Nobody knows where anything is going. It is now 3:20. We're 40 minutes away from the close. S&P sitting at 521. It was down around 519. Where's it going to be in half an hour? Not a clue. Not a clue. Is it going to recover? I don't know. It depends on the sentiment going into the close. Nobody knows. You can have an inkling. You can say, it feels good, but I don't know. I don't know. All I know is what I would do in both directions. That's all I know. So as far as your currency, all you can say is, what would you do if it went this way? What would you do if it went that way? And that's about it. Market close Monday. VIX reaches highest level. Given this elevated volatility, my belief that it is going to decrease, it always does, is a good setup to execute a short volatility trade. I did. Lots of them. As many as I could. Monday morning, market makers were being real pricks. The bid and ask on all the options. Some of them didn't even have a bid and the ask. Some of them weren't even open for trading. You couldn't get something if you wanted to. As much as I tried, it was like, the bid and ask were so far apart, market makers were not taking on any risk at all. Can you please show us the math on GM share buyback and how you come up with a price target from it? I'm guessing. Well, you just have to take... you can only really come up with an estimate, because if they're buying on the way up, then you actually get less of an increase. But they have just take their market cap, whatever their market cap is right now, and if you divide it by the number of shares that they have available, you'll get the current price. That is because the market cap is price times number of shares. Take the market cap as it exists today and divide just by 1 billion shares. If they're going to buy back 140 million shares, buy back, just divide the market cap by 1 billion and you'll see what the resulting price will be. You're just solving for the price. Said it'd be a crime not to sell volatility in the index around the stocks. Yep. How about selling call spreads on the VIX index ETF? Yeah, that's, I mean, yeah, I guess you could. I just, you know, I don't know the reason for getting fancy, but I mean, I guess you could sell call spreads on the VIX. Yeah, this could be the purest volatility play. Yeah, well, yeah, I guess if you look at it that way, if you're really just trying to play vol, you could. I think about it this way. I want to sell volatility, but I want to also sell it in a way where it has other advantages, such as the stock being put to me. Well, then I don't mind because I got really big premium for it. And if it doesn't, if the price doesn't get there, then I make money on volatility. So I don't want one outcome. I want to make a bet on something where no matter what the outcome is, I'm a happy person. I try to avoid straight up and down bets if I can. So buying a stock that has no options, that pays no dividend, that's a straight up and down bet. I mean, it either goes up or it goes down. There's nothing that I can do. There's no cash flow that I receive. It either goes up or it goes down. It's a straight up and down bet. Not a big fan of that. Not sure if I follow your statement. 100K increase in population will require 62.6 increase in jobs to keep unemployment stable. Yep, it would. Unemployment rate change stability is dependent on unemployment and labor force increasing at the same ratio as existing employment rate. Nope. No. I think you're thinking too much about it. So let's say you have a population of 100 people. Let's make it 1,000. And let's say 62% of the population is in the labor force. So the labor force is 620 people. And let's take 30, well, let's just say, I'm trying to get to a nice round number that we can work with. So we'll say 620 times 0.9. Let's say 558 people have a job. These are employed. There is your labor force. There's your participation rate. Here's population growth. You'd have 10% unemployment. Now, grow the population by 100, right? You have another 100 people. You still have the same participation rate of 62%. So the labor force would grow by 62 people. So you'd be at 682. And if you take the 682 and multiply it by 0.9, you're about 614. That if 614 people were employed out of 682, you'd have 10% unemployment. How many people is that? That is 56 people would have to get a job. So you have to continually increase your labor force, the number of jobs that you have to produce would have to grow at the same rate as your labor force would have to grow at, just for unemployment to stay the same. But let's say that this didn't happen, that you said, okay, well, you know, nobody got a job and nobody lost a job, so you have 558 divided by 682. That is now 558 divided by 682, negative plus 1. You have 18% unemployment now in that small example. So you would have to have job gains equal to the population growth times the participation rate. With a day like today, I could just picture a massive shock. Yeah, I did. Psychologically, how do you deal with a day like this when it's a bloodbath globally? I want you to imagine a store that has a 20% off sale. So you go to the store, and while you're in the store, they announce 30% off. Well, you get a little bit more excited, right? And then you start looking around going, well, now I'll buy this. At full price, I didn't want it. 20% was enough, but 30% is nice. And then over the speakers, they say now everything is 50% off. Suddenly more things become interesting to you. Aren't you getting excited? Everything is getting cheaper and cheaper and cheaper, right? So aren't you getting excited? That's the way I look at it when the market is dropping, is that everything is getting cheaper and cheaper. And there are things I want on the shelves that I've looked at for a long time saying, I like that, but it's just too expensive right now. And now it's on sale, so the longer I wait, later in the day, an hour later, it's on sale even more. Maybe tomorrow it'll be even cheaper. So you wait and you hope that, well, maybe it extends into tomorrow and it'll be cheaper tomorrow. That's the way I look at it, is there's a lot of nice things I had on the shelf that I wanted, but I just thought, too expensive. Sold GM December 40 puts. Concerned that if GM buys back its shares before December, I miss out on the potential stock price gains and I don't yet own the stock. Yeah, but you would make all the money on the puts, right? You better sell at the money or even in the money September puts. I don't see GM doing a September buyback. If anything, it'll be a fourth quarter buyback. Do you think the sell-off was overdone on Thursday and Friday? I don't know. I think it was too much based on what we had in certain parts. I think it was well overdone on yield. Too much buying of bonds, I think. I think it was exacerbated by fear of a full blown-out war in the Middle East after Hamas leader was executed in Iran. Immediately post this news hitting the market, option premium skyrocketed as well as volatility and increased amount of activity. That is what truly led to a sell-off. I did see earnings of many companies that beat significantly, have good guidance, but the stocks are up close to 8 or 9. That's usually a sign that you're sort of past the top, is when stocks just don't go up on earnings anymore. When bad news is actually bad news and it's no longer good news. And we saw it earlier, I think we're at Wednesday here, Monday, Tuesday, 2 rallies that failed on the strong uptrend. We had sell-offs that failed. You'd get a 1 or 2% sell-off and it would be bought up immediately and up we go. Now you're getting these 1 or 2% rallies and they're immediately getting sold. So now it's, companies that still have fairly decent earnings aren't getting rewarded. Interrent last night reported earnings and they were good. And even had a price upgrade today from one of the Canadian banks, and it sold off. Was up for maybe half an hour, 45 minutes, and then it just started selling off. So it's a take profit sort of attitude, I think, that's taken hold, which gives good buying opportunities for me. It's hard to bring it down to any one thing. Everything is always a web of things together, right? So it's hard to, because it's a system, it's hard to really name one thing unless it's some big obvious thing. It's hard just to say, well, it was this, no, it was that, no, it was this. It was a combination of many things, I think, at that point in time for a market that many believed had gone a little past itself. You once said tech is deflationary. That's true. If that's the case, wouldn't you want to position yourself in big tech that isn't overbought? Show me big tech that isn't overbought. The likes of Amazon, Google, Meta are raking in insane amounts of yeah, they are, and you'll pay for it. You'll pay your multiples for that. Those companies are nowhere close to free. They can choose to deploy it however they want. Right now they're spending it on AI and data centers. They have the ability to pull several other levels and pivot quickly. And what does that mean? You can say that of any company. GM's pulling in a lot of cash flow and they can pivot any minute really quickly. I mean, yeah, and so what? I don't know what that what that has to do with big tech isn't overbought. They're overbought. So I guess I'm just not following. The last sentence, you can say that of every single company out there. Companies with cash can choose to deploy it however they want. You know, many companies are spending it on AI, but they have the ability to pull several other levels and pivot. So does every other company out there. So I'm not quite sure what that point is meant to be. But your premise in your first two statements is incorrect. You have mentioned in the past that the U.S.'s current fiscal spending path will force the Fed to bring rates close to zero. Yeah, since there is relatively low multiple effect in government spending, could it be argued that the drag from G won't affect GDP much? It's not the drag, not so much the drag from GDP. It's not necessarily the multiple per se. It is the cost of the debt, and that's going to have to come from somewhere. It's going to have to come from somewhere. You got to pay for it. So either you don't pay for it and you just keep getting higher and higher debt, which means you get higher and higher interest expense, or you got to pay for it, which means you got to tax people. And if you start taxing capital, capital leaves. So it's damned if you do, damned if you don't. The only really thing that can be done in the short term, because you can't count on politicians to do the right thing. Just get that out of your head. In a democracy, it's not going to happen. You need a dictatorship to get that done. There's a reason why corporations are structured as a dictatorship. Is because you need somebody that can make those kind of decisions, and that's it. It's going to happen, period. Well, democracies don't work in corporations, right? So this will not be fixed. The only thing you can do is make the debt free. So that is my thinking of why central banks around the world in Western economies will have no choice but to go to the zero line. Whether they want to or not, they'll have no choice to go but to go to the zero line, because you cannot count on your politicians any longer. That's history. I'm not even sure you could ever count on them. But there was a time when when they were at least qualified. Now it's just a dog and pony show. You know, drama teachers running a country, part-time drama teachers running a country. You know, and implementing their version of an ideology that is purely experimental. You know, this is what we have. Okay. How you implement a carry trade as a retail trader. In the applied level in portfolio construction, 1 week we did actually do a carry trade. Why did the Japan one-day market downfall impact the U.S. market, or did it even impact it? I'm sure it had an impact. But trying to pull apart separate impacts, I don't know is of much value. Would it be possible for a retail investor to enter into a swap? Nope. One factor to consider for increased participation for JJ is graduate students from four-year university. That is considered. The numbers you get for the jobs are seasonally adjusted. So if there is an increase of graduates coming into the workforce at this period of time, the numbers would seasonally adjust for that. It would say there's always a jump at this point in time. So the increase at this point in time would have to be more than the general increase at this point in time to actually be a seasonally adjusted increase. So they are seasonally adjusted. Relationship between the yen carry trade, Nikkei dropping, and tech broader market sell-off. Well, I think it comes down to a lot of investors borrowed in yen and invested elsewhere. Where did they invest? Wherever they invested has to unwind. The obvious one is the peso. The peso's had almost a one-for-one move with the yen. Almost a one-for-one move. So we know that money went into an interest rate carry trade, which it should, money market to money market, because the peso is the exact opposite of the yen. More bold carry traders would have gone into something, may have gone into something riskier, um, using the low cost of the yen as their finance cost, and willingly accepting the interest, the currency risk, um, and maybe even hedging the currency risk. And if you hedge the currency risk, if you were money market to money market, all you could earn was the Japanese money market rate if you hedged, which is why you don't hedge when you're money market to money market. But if you're money market to equity market, you might hedge the the yen, uh, uh, hoping that you would make more than the money market return in the target market you went to. And that just could be the unwind of everything, everything that we've seen. I mean, everything that we saw could be the unwind. Any significant changes in CFA level 3 curriculum for portfolio management? Not really. No. Which diffusion index are you looking at? It is at the bottom of the establishment survey. The last two lines. Thoughts on Buffett selling his Apple stake? My understanding is he had them at such an incredibly low price that once you get to, 220, there's always the question of, well, where's it going to go from here? He's clearly not going to take Apple private, not at several $1 trillion, almost $3 trillion. He's not taking Apple private. So unless you think there's a lot more upside, maybe this is as good as it gets for a while. GM is not known as a quality automaker. Says who? My first car. Oh, you said because you had one. So you had a bad experience. So you're using your your N of 1 and extrapolating to the population. Does your investment make sense for a car maker not known for quality? No, neither is Tesla. Tesla's got, of the 4 automakers, the lowest quality. By your argument, Tesla should be selling at a forward multiple of 3 times because GM's at 4 times. So that would put Tesla at, earnings of about $21 a share, $20 to $21 a share for Tesla. Be careful about extrapolating from a small sample to the general population. If your statement were true, GM would not be putting up the numbers it put up. It would not be raising guidance. It would not be the largest automaker in North America. It would not be increasing its market share. It simply wouldn't if what you say is true. You had a bad experience with a car. That happens. That does not mean that everybody thinks the way that you think. And if everybody did, we wouldn't see these numbers. The market wouldn't be showing these numbers. And if the quality, as you say, were the deciding factor, Tesla would be at the bottom of the pile because J.D. Power, out of 50 vehicles every year, ranks Tesla in the bottom 10 almost consistently in terms of quality of the vehicle. So, you mean steepeners? This is a steepener move. On the yield curve, yeah, it's steepening. Did I say flattening? It's steepening. Can you talk more about using a box trade to convert RSP income into capital gain? Yeah, it is tricky to do. You have to do it at certain times, and what you have to find is a loser. Here's your RSP. You're going to need a different broker altogether. Here's IBKR, and let's say your RSP is with a TD Bank or any other bank. What you're going to do is you're going to buy something here. You're going to go long a real loser. You're going to buy a loser, and here you're going to short that loser. Right? You're going to short it the same dollar amount. Your hope is that it drops because here's your gain. This gain is a capital gain. right? And now you have less money in your RSP. You've effectively removed money out of your RSP doing it. But box trades are illegal in Canada. A box trade is being long and short the same stock. So to get that done, you're going to need two different brokers. If I tried to do that at IBKR, because I do have an RSP, and I do have a taxable account at the same time, that if I tried to do that, a short position here, a long position here, or a long position, sorry, and a short position, I'd get called on that. Compliance would be contacting me almost immediately. Even if you have different accounts, not even different accounts under the same name, but completely different logins, completely different accounts, they would be related through the common individual, that you still get called on it. You need separate brokers altogether that don't talk to each other. And you could drain your RSP into IBKR. Now, what happens if you're wrong and you bought the loser, but you were wrong? Well, this will increase in value and this will lose money. Well, this is a capital loss that you can use to offset any other capital gain, and you'll get a tax savings, and you will have advertently over contributed to your RSP without getting a penalty for it. In other words, the capital loss you have here offsets the capital gain. It's deductible. But you can't over contribute. So it's the same as making a larger contribution than you should and protecting your income over here. So if you want earlier in your career to reduce the amount of taxable income, is short a real winner in IBKR and buy that real winner in your RSP. No matter what happens, you don't win or lose anything. You'll either remove money from your RSP at a capital gain rate, or you'll over contribute to your RSP and save taxes, one of the two. That is why the box trade is illegal, is because you could do that. So don't do that. Where are you getting volatility percentiles? I've already answered that. I guess I can let that go. Musk wants to delay tangling with the unions for as long as he can. Buying GM would hasten that confrontation. No. Well, let's just look at it this way. GM does have a union. Tesla doesn't have a union. GM is more profitable per car than Tesla is, even with a union. So that means that the GM workforce is more productive than the Tesla workforce. When you have a union, you rationalize your labor force as much as you possibly can. When you don't, you may allow a little bit of laziness. You're not going to optimize or rationalize as much as you can. So it could be that the union actually induces you, to be a little bit more aggressive on your costs. Regarding your question in the live Q&A about creating a cult from an anti-cult of easy solutions and other BS like I am. Oh yeah, I am. That's what it's called. Don't you think that through your own work you're already attracting those who value discipline, process, and education? Those who are committed to this path are already following it, while those who aren't interested in hard work likely won't change their minds no matter what you do. Some people simply prefer avoiding hard work. Yeah, it's true. But it's a smaller part of the population. It's always a smaller part. I doubt that anybody listening here is pulled in by these type of charlatans. I doubt if anybody here falls for that kind of stuff. My point that I was attempting to make is, how do you get those big audiences without doing that stuff? How do you turn what I do into a cult and not something that is got small audiences? I'll always have small audiences. I'll never have those really, really big audiences. To get those really big audiences, you have to tell people what they want to hear. Not what they need to hear, but what they want to hear. I'm almost tempted to start another channel on crypto and bring, intelligent conversation to crypto so it sounds good, so it's half intelligent and half bullshit, and just tell people all the fantasies that could possibly happen here, and just start talking about it. I bet you I would get to 500,000 subscribers on that channel within a year if I just start intellectually or pseudo intellectually talking about crypto. I could pull it off. I'm sure I could. But I'd feel really dirty. There'd be a lot of people listening that might even lose a lot of money. But I could do it because there's a lot of people that want to hear that. They want to hear that it's true. They want to know they can make a lot of really easy money, and here's all you have to do. And if the audience is big enough, you can actually create the effect that you say you're talking about. You get a big enough audience, you find a small little crypto somewhere, you look at the blockchain, and you come up with a story that people don't get this with this blockchain. They don't quite understand what's going on. This blockchain is very, very close to being picked up by the Chicago Board of Options as the clearinghouse now. This will be the new clearinghouse. You're talking about going from nothing to being worth billions overnight, people. And the crypto is going to be needed to process all those transactions. I don't know why it's so cheap. I'm loading up on this thing. My God, do you know how much at 500,000 people, do you know how much you can move a market by doing that? Do you know how much you can move a market? And look at the credibility I bring. Who's this guy? Who's this guy? Oh, he's apparently in the CFA space. He's really important. He's well respected. Oh, CFA space. Oh, he's got a PhD. Oh, PhD. Oh, wow. They don't look much further than that. You just need showpieces. That's all. I can do it because I'm telling a bunch of people exactly what they want to hear. But I'm not telling them what they need to hear. Nobody wants to hear what they need to hear. They want to hear what they want to hear. I want to hear that what I believe is absolutely true. I don't want to be challenged. I want you to tell me that what I believe is absolutely true and everyone else has the problem. I bet you that would make a good documentary. If there's a documentary filmmaker out there who wants to document that, I'll do it. I'll create a brand new channel and a brand new persona. And a brand new voice, and I'll talk about my conversion on the road to Damascus and how I became a believer in crypto because of my research. And oh my God, there's been, we're missing the big picture. Everyone's looking at Bitcoin and Ethereum, and it's over here. It's these little guys, and I'll load up on that crypto first. First I'll build an audience. I'll tell people what they want to hear. I'll be the biggest evangelist for it. I'll hold rallies in certain places. I'll be in this town. I'll be in this city at this convention hall, and I'll unveil, 2 or 3 new crypto trades I'm looking at. Oh my God, the following I would have. Just think about it, that if I wanted the easy money and the easy way out, it's right there. It's right there in front of me. And I could do it. Now, how do you do what I just said, but for real? Real stuff this time, and get that excitement and get those crowds? You can't. You cannot get that. Very few people will educate themselves. Many, many, many more people want the easy way out, will not educate themselves. They want to be handed an answer and told a dream that they're about to have if only they did what you told them to do.